John, you've written, and many, of course, are in your camp, that what's going on with stocks is putting a whole lot of extra demand in treasuries and sovereigns in general and a safer investment. How do we calibrate that against the obvious downward pressure of other central banks' policy and lack of ability to remove stimulus?
Well, the big challenge with equities, of course, is profit expectations have slowed for 2019 relative to 2018 based upon slower global growth. When you have those lower profit expectations, people are looking for safer returns or steadier returns, and that's shifting over into the bond market. So that bond equity calibration always goes on, sometimes obvious. Right now, it is very obvious.
You know, if you overlay the S&P 500 on top of 10-year note yields since the beginning of 2018, with S&Ps very close to where they were in early 2018, what you see is after January 3rd, everything diverged. Lower rates became a way to adjust multiples to allow stocks to rise. But what we also learned in 2018 is rising yields for the right reason also propels stocks. Are we ever going to get back to that? And is the former going to run out of gas, the lower rate advantage to stocks?
Well, I think the lower rate advantage is gradually disappearing simply because those lower rates are associated with lower economic growth. If it was stronger economic growth, if the growth in the economy was picking up, that would really help the overall equity market in general. But that balance always is there. In the short run, the fundamentals are really driven by what's happening with the volatility and expectations. But over time, those fundamentals will reassert themselves.
Now, something odd happened yesterday evening. The U.S. Department of Commerce issued what they call a notice of a proposed rulemaking. Basically, and I'll summarize, they want to create a set of penalties to allow the U.S. government to go after countries that manipulate their currency for export advantage. What do you think of that?
Well, it's kind of intriguing to me, Rick, because I thought the U.S. Treasury was the one to decide who, in fact, was manipulating their currency. Now, basically, what the Commerce Department appears to be doing is setting up specific penalties so that nations will know that if they're in violation, this is what will happen. That creates a certain level of certainty, I think, for other nations and says up front, if you mess around with the currency, here are the penalties, be aware of that. And I think it's actually more transparent in terms of information and actually will discourage countries from manipulating their currencies.